I am at a loss for words regarding the current state of the Hong Kong stock market. Just take a look at the top performers, stocks that are doubling or tripling within a day, only to reveal massive losses when you examine their price-to-earnings ratios. So, let me tell a story about the US stock market instead. Yes, I'm talking about US equities. The GameStop, GME stock price surge and subsequent crash in early 2021 exemplified the classic characteristics of liquidity-driven speculation and sudden liquidity droughts. Several key factors contributed to the A-shaped trajectory of GameStop's stock price. Liquidity speculation refers to the scenario where substantial short-term capital floods into a particular stock or market, driving its price sharply upward over a brief period. In the GameStop episode, retail investors, primarily through social media platforms like the Wall Street Bets community on Reddit, coordinated a mass buying spree of GameStop shares, creating enormous buying pressure in the short term. These retail investors employed leveraged trades and call options, which significantly heightened the market's liquidity demand for GameStop shares. Institutional investors, particularly short-selling hedge funds, faced a short squeeze. As the stock price soared, short sellers were forced to buy back shares to limit their losses, which further propelled the stock price upward. This short squeeze effect amplified the impact of liquidity speculation, causing GameStop's stock price to skyrocket well beyond levels supported by its fundamentals. A liquidity drought occurred after speculation reached its peak, when the influx of buying capital abruptly diminished, leading to a sharp price collapse. GameStop's fundamentals, such as its operational performance and profitability, could not sustain the elevated stock price. Once both retail investors and short sellers had completed their transactions, buying demand evaporated rapidly. When liquidity dried up, the stock lost its upward momentum, and many speculators began offloading their shares, causing the price to plummet. This decline reflected not only the cessation of liquidity, but also a shift in market sentiment. As the stock price plunged, some early buyers who hadn't sold in time suffered significant losses, forming the peak and subsequent rapid decline characteristic of the A-shaped price movement. Liquidity-driven speculation caused the stock to spike dramatically, while the sudden liquidity drought led to an equally steep decline. GameStop's share price surged from tens of dollars to hundreds within a short period, but as the speculative fervor cooled and selling pressure mounted, the price quickly fell back to lower levels. This pattern typically occurs with stocks that are not supported by strong corporate fundamentals, relying instead on market sentiment and liquidity dynamics. GameStop is a prime example, as its fundamentals saw no substantial change, yet liquidity fueled extreme price volatility. The GameStop saga demonstrated how liquidity-driven speculation can lead to irrational short-term stock price surges, and how the abrupt exhaustion of liquidity can quickly bring such irrationality to an end, resulting in a steep decline. This phenomenon is especially prevalent in junk stocks, whose fundamentals do not support sustained long-term growth. As for the Hong Kong stock market, there is certainly potential for valuation recovery, and there are excellent internet companies with high investment value. However, the speculative frenzy surrounding loss-making companies with no earnings is bewildering. Valuation recovery aims to correct valuations, but these loss-making stocks have no valuations to correct. What exactly is there to recover? Additionally, there is a well-known saying in the stock market. In a bull market, prices rise slowly and fall quickly. In a bear market, they rise rapidly and fall slowly. This means that during a bull market, prices tend to inch upwards over several consecutive days, followed by sharp corrections before setting new highs. For instance, when observing the recent U.S. bull market, we can see frequent large red candles indicating sharp declines, while the green candles representing gains tend to be smaller. On August 5th, there was even a 5% gap down at the open, which is indicative of the rhythm of a bull market.